Welcome to the Dividend Talk podcast, episode 287. How to spot and remove Deadwood from your portfolio. European EDGI, another mad week in the markets this week. We're going to get into the news in a few minutes. The world is a crazy place, I would say, and it's driving oil, it's driving share prices, it's driving everything sky high. So I'm looking forward to your thoughts on that. But before we get into all of that, how have you been this week?
Again, this funny question that you continue to ask for 280 episodes. Thank you so much, my friend. No, I've been doing well. Busy week at work, of course, but dividends are coming in, so I can't complain. And yeah, we're now after a dividend hike season, right? So I still would need to make up the balance a little bit, but it feels like I had a good year already with all the announcements that were coming up so far. So I think half of the year in terms of dividend hikes is for me defined in February and March so far. So yeah, it feels good generally. It feels good. So
Yeah.
I'm a happy man so far, a happy camper. And spring is starting now. So I start to get already a bit the spring vibes. It's wonderful weather here. Garden will need some cleaning anytime soon. So this topic around spring cleaning a little bit, Deadwood, comes in handy.
Yeah, and it's directly after you released your annual report as well.
Yes, did you read it?
Yes, of course I read it.
Okay, what is your main takeaway?
It's very interesting. One thing, and I think I said it to you, but might be worth a discussion, your word of caution about what's happening in the world, very, very apt at the moment, and maybe moving the balance a little bit more to a European-based portfolio. We are Europeans, remember, so it might be a good topic to pick our brains on that, because I think my portfolio swings a little bit that way. But it might be a good topic, especially for our European listeners.
Yeah, and interestingly, I think at the time of writing, the currency was 1.18, and it went from last year, I think, from 1.314 to all the way 1.20. And today, I think I checked, it's around 1.14. Yeah, so just this week again, 3-4%, let's say 3% strengthening of the US dollar. So it's quite swinging. That's not a light move, I would say.
No, and I think you've triggered a lot of people from the comments around currency headwinds and tailwinds and how it impacts your portfolio. So quite interesting. I won't ruin it for most people. Go and give it a read. It's worth checking out, which most people
can find it
have.
on EuropeanDGI.com. It's one of the first posts visible there.
Yeah, we'll link it here. So before we get into the news, again, with the disclaimer, this is not financial advice. Everything we say is for our own entertainment. Anyway, news of the week. And look, we got some questions around Iran, our thoughts on it. Oil is at $100 a barrel now. How are you reacting to this? What does this mean? So I know you release something around Shell at the moment as well. So I'm quite curious to hear your thoughts on this.
Well, first of all, we are such an expert that we can't even pronounce the channel of hummus really well. The nice food that we love to eat from the Middle East, right? So we call it the channel of hummus, which is quite funny in itself. But look, it's a shit show. What's all happening? And I didn't have $100 oil on my bingo card for this year. Yet here we are. Isn't that how interesting? How unpredictable everything is in the world at the moment. Probably has always been there, but now we are the adults that are observing this for the first time, right? I guess our parents might still remember the early 80s with the oil issues there. So for us, this is probably all a little bit like new, and it feels like new. But oil at 100, I mean, I was thinking about this a little bit. So Shell went up from maybe 33 euros to 37, 38 euros, 10-15% over time. ExxonMobil had a really strong run up. That is going to give it a lot of cash flow in the dollars. These companies are break even around 40, 50. So I'm wondering when we will get the first state intervention. Luckily, Shell is from the UK. Yeah, we can be really happy with that. But I'm still wondering if they are going to put a tax on it. People are already complaining about fuel, that it's like almost €2.5, or it is €2.5 in the Netherlands, which is crazy. I mean, still, of course, the government is the biggest oil beneficiary there when it comes in terms of tax. 2.5 euro. I mean, that's crazy. Yeah. What does a car drive? 1 on 12 to 1 on 15 if you have a typical fuel car.
Yeah.
Yeah, that becomes a very expensive trip to work.
I know it's getting close to that in Ireland at the moment. It was €2 in some places. And I noticed it straight away. I do a lot of traveling on the weekends, both Saturdays and Sundays now. And I noticed it last week. I have to say it was a big difference.
Yeah.
So as an investor, you're like, yay, loads of free cash flow for Shell. But I'm like, I don't own that much Shell to offset the cost of this oil that's costing me at the moment. So.
Yeah. So I'm talking about Shell. I looked up today, and I think that's what you're referring to. They only pay a 3.3% dividend right now. At this moment in time, I know they announced what was another 3 billion dividend buyback again, or share buyback in 1 quarter. I think they should stop it. I think the CEO should say, now guys, at this level, I stopped the buyback machine. We're going to put everything towards paying down debt. There's no sense in buying at this level for a 3.3% yield that you will be retiring. The debt is probably at a similar cost or even more, right? Because the rates lately have been more around 4 and 5%. Start paying down the debt. Over the last few quarters, they have been actually increasing the debt a little bit with the share buybacks. I would say, come on, guys, it makes no sense. It really makes no sense. I don't mind then if they later take a little bit debt on when they can buy back at 6 or 7%. Yeah, but don't do it at 3.3%. It really makes no sense for me. We don't need it as a shareholder now.
And I have to say, the previous CEO, and the name is gone from me.
Van Beurden.
Yes, he definitely, when we had a period like this, he definitely used the excess cash flow to aggressively pay down that debt, I would say. So let's see if, when I read the CEO's name, Wales Swan, it was like Bob Swan came to my mind. But I'm with you on that. I hope they strengthen up that balance sheet, because you get periods like this when it's going to spike their cash flow. Don't waste it. Yeah, don't waste it. And I liked your tweet to them, and it's like, at Shell, thank me later. A little bit of advice for them.
Yeah, no, but I think like it makes no sense. I'm a shareholder. I love the buybacks, but not at this yield. Yeah, don't do it. The balance sheet is not the best balance sheet of the industry. That's ExxonMobil. Strengthen it now. This was always done to pump up the share price. They've got it now. They've got a good share price.
Yeah,
for this. So stop it, strengthen the balance sheet, make your company more strong, and use the money later to buy BP or something like that in 5 years or something like that. Yeah.
Looks like you're looking for the job as CEO of Shell. You are Shell man, after all. So
yeah, true. And then when you then look at it in general, I just generally see that this war there has a lot of risk. Yeah, for instance, to the dollar strength, to the dollar currency, the dependency on oil. And I'm so happy just that my portfolio is very diversified. Oh, it's hedged. For instance, Lyondell Basel trading at $74. Who would have ever expected? Another one that I didn't have on the bingo card. Not too long ago, it was a $45.
They cut their dividend and it just soared afterwards.
Yeah, exactly. Also, because they sell certain commodities, mostly also in America, produced in America. So commodity prices are going up. So cash flow should recover for them as well. Of course, share price is going a little bit ahead of itself. But this is what I always mean. Like, there are 11 sectors. Make sure that you're a little bit diversified, and it's not like I'm I would say the Nostradamus. Not at all. But it's just like there, in one time, this happens in the world, you have a bit of hedge in your portfolio. If you're over allocated to the same type of companies all the time that benefit from the same secular tailwind, when that busts, you don't really have a protection safety net there. So, and so it's not like a genius here, not at all. It's just I see the hedging all the time in my portfolio, Derek. It also takes out some potential for growth, but it makes me so much sleep better at night.
Good. So let's go to the dividend announcements. And before we get into that, Centrino sent us a question. And he asked us, when announcing the dividend hikes, could we also mention the new dividend yield? So we will try our best. I can't make any promises we'll do this every single episode, but we will do it. We'll do our best. So quite a few, not that many this week actually. Hanover Rook. I'm not familiar with the company, but Hanover Rook, is it Rook? You pronounce that name. It's definitely German.
Yeah, it's usually Hanover Rückversicherung.
Yes, that. They increased their dividend by 39% to €12.50, giving them a forward yield of 4.8%. Swiss Life Holding increased their dividend to 36.5 Swiss francs. That is up from 35 Swiss francs, giving them 4.5% forward dividend yield. General Dynamics hiked their dividend by 6%, giving them a 1.65% forward yield. Rubis had a small 2% increase, and that gives them a 6.2% yield.
Do you own them, Rubis?
I had a small position in them while I was looking into them, but then I didn't really hold on to them. I didn't look into them. So
I'm curious why you considered it Deadwood at the time, but maybe that's something for soon.
Yes, we're coming to that. Legal in General had a 2% dividend hike. They also announced a 1.2 billion share buyback program, and they have a forward yield of 8.87%. And Realty Income, 32 years of consecutive dividend increases, increased their dividend by 0.2%, but it gives them a 5% dividend yield, which is interesting, right?
Yeah, definitely. I mean, it continues to compound, but very slowly, very, very slowly. But, Realty Income is one of those companies that is just for me like on the shelf, let it grow. And, the share price is now $65. It was for a long time around 52, 53, 55. My average price, I think, is $55 dollars in general. So I'm quite happy with this one.
Yeah. It's almost like a set and forget. I don't
it's a
even
bond.
Yeah, I don't even check it half the time. It just does what it's doing, which is quite nice. So today we're talking about removing our deadwood in our portfolios, or at least how we spot that and how we go through that process, which is quite timely, I think, after your annual reporting, your spring cleaning and all that.
Yeah, my spring cleaning will come up. So and when I was thinking about the spring weather outside, I felt like, deadwood, because literally I was cutting some of the deadwood today in the garden.
Yeah, it's almost springtime for you, and I know that means garden time.
Yes.
So, but I'm interested to hear what does deadwood mean to you in a portfolio?
Yeah, so deadwood for me means like a company that just doesn't belong in my portfolio anymore. Let's call it like that. Yeah, and it's this is such a big dilemma always for me, and I'll just bring out straight away the elephant in the room here. It is like your portfolio is like a bar of soap. Yeah. So don't touch it too much. Yeah. At the same time, I'm doing spring cleaning. Yeah, as well. So, but yeah, okay. So what's that wood for me? Typically, companies that have a very high payout ratio doesn't seem to grow anymore. Maybe even losing market share. Yet they still have a very high valuation. Yeah. Other ones are like companies that suddenly start to do desperate acquisitions because they can't grow organically anymore, but they are doing it at a level that you really wonder, like, is this ever going to earn them money? I think we all know Bayer, in this case.
Yeah.
Some have very huge debt on the balance sheet, and it continues to increase. So, like, for instance, we have AbbVie, bought Allergen. Lots of debt on the balance sheet, but they started to pay down straight after, right? Still, I would say is a little bit, a lot of debt on the balance sheet, but you see the intention here. But there are also maybe companies that do the opposite. I think Intel was a really good one, losing market share. It had almost the things at the same time, losing market share, big bet on their innovation, free cash flow heavily in the minus, one that I definitely burned myself even on and had to cut the deadwood. But one of the most important ones, but also sometimes the hardest to spot, is that your thesis changed. Like, why did you buy it in the first place? Yeah, and do you still want to own it? Example for me was very, very clear when Viatris sold their what was it called, the biotech part of their business.
Generics, yeah.
Yeah, the generics, yeah, and then only Viagra was left. I mean, yeah, there are less and less older people coming up, so yeah, less of those blue pills to sell.
Yeah.
Yeah, and there may be just companies that are facing secular headwinds. I think here actually a good example, and where the dividend isn't growing, right? Because the company can't, and that's the Rowe Price. Yeah, I see that also. The question is it all Deadwood? But definitely when it has a combination of these factors, I think that's typically a Deadwood. And also, they may still have a safe dividend based on the historical part of the questions we ask, but forward it may seem to be very trending down. Yeah. So this really important for me, and this is what I really look for, or what I really consider Deadwood. You just need to prune from time to time to let the rest grow.
Yeah, and I think an important step is probably knowing what is in your portfolio in the first place. So why did that company get into your portfolio? Like that, you have to come up with a thesis. You just mentioned there one of the hardest things is your thesis changing. But it shouldn't be that hard if you just write a simple, it's like a mission statement, 2 or 3 word sentences maybe around what your thesis is. And that kind of will help you
but
a little bit.
Thesis change is sometimes very slow, Derek.
Yes, and also your view of the world might change as you get older and things change. Your view of maybe what you thought 3 or 4 years ago, as in what will be secular headwinds or tailwinds, might not maybe transpire.
I give you an example. Microsoft, my thesis was it's going to benefit from the cloud. When I bought it, let's say 8 to 10 years ago, it did in the first few years, and it still benefits now a bit from the cloud. But it's a different company, different business. My thesis is now also around AI and everything. Yeah. In this case, it was a success story, right?
Yeah, of course. But there's other companies that maybe made sense 3-5 years ago. I'm going to say Diageo, Enagás, Starbucks, to a certain extent, when that CEO came in and went a bit bananas about selling their brand or whatever it was. But these companies make sense 3, 4, 5 years ago, and they change. Markets change, people change, behaviors change. So that invariantly changes your thesis, I think. So I think it's really important to come up with a thesis. You do probably have to reevaluate it from time to time, but you have to be careful not to be biased. And you think, I think Diageo was probably a really good one for me in learning. I did a YouTube video on it. It was probably a bit of bias in me. Like there was a lot of stuff staring me in the face that I wrote about. But there's also bias as a consumer of Diageo, and Guinness is my favorite drink, and it's Irish and the heritage behind that, and you give it the benefit. So it's hard to come up with a thesis and stick to a thesis and actually see that play out. And if it doesn't play out, it's also difficult to admit you're wrong. I think that's the hardest thing for people.
Psychology
not just
is a bitch.
Yeah,
right?
of course it is.
That's because you really get this confirmation bias. Like, okay, I bought it and it has to do. And then if the share price goes down, let's say you bought at 50, the share price goes to 40. How many are waiting till 50 to sell it again?
Yeah. I mean, who knows? Who knows? But yeah, I think when you look at Deadwood, fundamentals, when they change, that's the easiest thing to spot. Like, in theory, is it right? Lower volumes, strain on free cash flow. I mean, increased debt. Now, I know you have increased debt, and you spoke about acquisitions with AbbVie, but what about someone like Nestle, who are increasing debt to pay the dividend or fund buybacks? I mean, debt from acquisitions is one thing because that's there for growth. Debt when you're paying for buybacks and paying for dividends, that's a major red flag.
Yeah, but then a Nestle shareholder would say, yeah, but also the Swiss franc was getting weaker.
Exactly.
Or something like that. And therefore they had to do that.
Yeah. And look, it's a valid point. But you just have to be mindful of where that and why that debt is increasing, I think. Fundamentals are easier. I think what's harder is like market behavior changes. I spoke about Diageo. I don't want to harp on about them, but maybe someone like, I don't know, munch-owned machine where their whole revenue model has completely changed in how they report it. So they're now only reporting the affiliate income that they get from, say, other desks. So that changes things. It also changes their free cash flow. It was elevated over the last 2 years. It's now going to be rebased around 2 or 3 years ago. So is that a red flag? It's not. You just have to understand it. Or someone like NESF, an investment trust that I mentioned before on this. I know a lot of people have it. But their NAV price has been declining year over year over the last couple of years, which is not good when you have an investment trust.
Like UK wind?
Yeah, exactly. These UK wind, NESF are in the solar segment. And not only that, the price power has been revised downwards in the UK, which means the revenues will take a lower hit. So the revenues are going down, NAV is going down, their discount is getting larger. So that means my thesis has changed. So do you sell or not to sell? And they're the type of questions that you have to ask yourself.
And then what about, let's say differently. When I look at my portfolio, I can see kind of already spot where the dead wood is, like almost like the colors of the wood in the tree. Do you have that as well?
Yeah. And
sometimes
cases,
you just see it, right? And then you just know, like, why do I have this even in my portfolio?
Sometimes you just have companies and you wonder why you bought them. I think it all comes down to your thesis at the start. Like, are you buying them for momentum? Maybe there's something in the news. Walgreens, I know you haven't mentioned, is a perfect example. VFC was another one that I owned. Intel was another one. Just complete Deadwood in portfolio that you just have to get rid of. But maybe there's ones like CEO changes. They are harder to spot. I mean, again, we have Starbucks. They're after making 3 or 4 different CEO changes over the last couple of years. They have to keep going back to the original CEO just to get the company growing again. Does that make them Deadwood because the strategy changes? Unilever changed their CEO. We see Diageo come in, he cut the dividend straight away. There's some of them not so difficult to see. But the problem is, okay, you mentioned it. Your portfolio is like a bar of soap. When you spot the Deadwood in your portfolio, do you struggle to sell it or are you quick to just sell it straight away?
No, I struggle to sell it a little bit because I have one thing there that's typically opportunity cost. I would need to know what I want to replace it with at that time. Sometimes the Deadwood is 6% yielding, and then I wouldn't like to lose income. Yeah, so I'll be totally honest there. I don't want to take a step back in income, but then there needs to be a high quality 6% yielder in return for that. Yeah, but usually I'm already fully allocated to those positions, so it's not easy, Derek. Really not easy. If it's really like Deadwood that someone else will break it for me, yeah, then I sell it. But sometimes it's kind of on the edge. And then I don't want to lose necessarily income, and that's a psychology that is like the unwanted roommate in my head at that time. So far, usually I've been doing well with that. Versus 3M was a good example for me with all the litigation. I replaced it with NN Group. Yeah, but it's not always that this opportunity is there. And then I catch myself keeping a stock longer in my portfolio than I usually should, if I'm brutally honest with myself. The 3% and the 4% yields are always very easy for me. Like Viatra says, at the moment, I just cut it out and I bought other stuff for it. Yeah, it was at 4.5% yield. Then, there was a chance to buy an insurance company and then combining with a lower yield. But I'm always have this anchor that I don't want to lose income. Yeah. And so for me, it's also about spotting Deadwood early. But then again, sometimes Deadwood starts to flourish later again, right? A little sprout comes on it and starts to grow again. So it's difficult. So I still lean towards bars or so. But if I look at my turnover in my portfolio, every year I'm selling 5-6 stocks, typically around May, that I just don't believe anymore. And for instance, Rowe Price is for me a really good example that I'm doubting about. I see the assets under management still improving, but there's a fund outflow. So it's only because of the stock market growing. But what now if we get a 2008 and the stock market declines with 40%? this company will be shattered in terms of share price and everything. And I know it has a safe balance sheet, like no debt on the balance sheet. But I just don't see a tailwind. I don't see them really punching any dent into the ETF market, the index market. So I'm really struggling with the future of this company. And now that I hear myself speaking, is probably a good example of Deadwood. Yeah.
Yeah, and it's also interesting because I hear you speaking about it. I can see you articulating quite clearly what you think is wrong. To anyone listening, it sounds like complete deadwood in your portfolio, but yet you haven't sold it, and you've been speaking like this for the last, I would say, 2 or 3 months on that.
Yeah. The one reason is that I'm more focused on buying shares than cleaning up my portfolio. Let's be honest here. But secondly, I'm just doubting because then I look at the balance sheet and I think it's really good. And then I think like, yeah, I don't own too much of it. So I have this very strong bar of soap analogy in my head at the same time. And these are like an angel and the devil on my shoulders, whispering in both my ears. Right? Yeah. And then the question is, what is wisdom? Ultimately, when it cuts the dividend, I'm most likely to sell shares. But how can I be a little bit proactive in that is also a question that I often have. And opportunity cost, but sometimes you may think that you're selling something poor and you're just watering the weeds with the money then after that. Yeah. It's really not an easy topic sometimes. Some like Behaviours at the time was really simple for me, the Deadwood. But Rowe Price is really one that probably classifies as Deadwood. Derek, but maybe I'm still like a little bit biased to something. Yeah, anchored to something here.
Yeah, there's kind of a balance between allowing a company room to breathe, and I think you did that with ExxonMobil, if I remember.
Yeah,
you gave them some room to breathe. You were always doubting, but you gave some room to breathe. Versus a company that is just fundamentally after changing and is broken.
That was Intel, where I really burnt my hands.
Yeah, and Rowe Price is kind of like in the middle of that. Dividend growth is quite low. Let's be honest.
It's a slow compounder, so it takes also many years to decline, and probably that's what we're seeing. Yeah. We're seeing Intel in slow motion here. Maybe that's it.
Yeah, exactly. But then you see other providers like that CME Group, for example, or just in that kind of space, not exactly like Rowe Price, but even asset managers in general. Blackstone, they're declining in share price as well a lot. So maybe it's just that whole area. So is it the company? Is it the sector? It's hard to know. So yeah, I agree with you. Rowe Price is quite a difficult one. I did see some positive signs. We spoke about them. Was it last week or the week before? That their margins are actually increasing with the ETFs. That they are more of an active ETF manager rather than passive. So you can't really compare them to Vanguard or BlackRock. But it's quite a tough one. So they're the ones that are difficult for me. I was a lot more trigger happy, I would say, over the years. I've tried in the last 2 or 3 years not to be turning over my portfolio as much, which I have done. But it's getting that balance right, I think, is quite difficult. There are some ones, and you asked me about Rubus earlier. There are companies that I would buy from time to time, and I'd buy a small, maybe couple of shares, depending on the share price, maybe 1, maybe 10, or just a small portfolio with the intention of maybe looking at them. Rubus was one.
True.
I think they are in, and correct me if I'm wrong, but they are in something around the sale of LPG and maybe storing it or something. I can't remember. I think it's storage and distribution of petrol and gas. But they were on my to-do list to review. I had them for about 8 months, and I just wasn't getting to them. So I don't need to hold them any longer. I'll get rid of them. They didn't interest me enough to do it in 8 months. It means it didn't interest me enough.
Exactly. I have that. I had that last year with Sila.
Yeah.
It was a real estate investment trust that came on my radar. I thought, interesting. 5 months later, I felt like, why the hell do I have this in my portfolio? And a very small ancillary position, so I got rid of it again.
Yeah, so I do that from time to time, and because we hear so many stocks, right? And they had a high dividend yield. It's like, oh yeah, I like high yields.
Yeah, exactly.
But yeah, didn't fit my portfolio. So I see that as Deadwood, and it's easy to
it's like with dating, right? You may have a great vibe after a first date, but then when you see the person for a second and a third time, you think like, shit.
Yeah, the chemistry's not there.
There's a beard.
I know. Yeah, but quite interesting, right?
Isn't it also an English term, Deadwood?
Deadwood is English
in
term,
terms of dating.
Oh, and yeah, it could be, yeah.
Just thinking about it now.
It could be.
I think we need to change the podcast title here because this will not be suitable for work. Oh my God! What title did we choose?
Oh, we'll move on. I might change the title. But I don't even know where to go from here. I'm actually surprised it took you so long we're 35 minutes in. It took you so long to realize that.
You didn't see it earlier?
No, I did not. No, it didn't.
Oh, I leave it up to you whether you want to cut this out or not.
Anyway, back to removing Deadwood. So final thoughts on that. Anyone in your portfolio now other than Rowe Price?
So Rowe Price definitely is one that I'm looking at. There are a few that are going towards Deadwood category. And the one that I already said was UK Wind. Here I definitely have this high yield that is really juicy and compensating. But does it make up enough for the loss in dividends? Or because the dividends will not make up for the loss of share price. So, but I looked into the last numbers and I thought it's still doing what it's supposed to do, although that the NAV went down, of course, which hurts a little bit the share price. But yeah, that's one. Other than that, I've got Magnum Ice Cream Company still in my portfolio as a spin-off from Unilever. I don't really feel anything for it. So for me, that feels typically as a Deadwood example. I would say that's mostly it because I cleaned up my portfolio quite well the other day. I think DCC, it turned really into a pure play energy company here. Yeah, that's also one that I need to have a better look at because the entire thesis changed and I haven't made up my mind yet on them. But yeah, I think that's it. I mean, I focused much more on quality in my portfolio and it's visible right now, yeah. Means also a little bit lower yield at times, but it really has done me, I think, well.
Yeah. It's a couple in my portfolio, but I kind of clean as I go more so than have a specific period in time of cleaning. And I mentioned NESF. There was a couple of funds that I had in my portfolio that are now gone since the start of the year. UK Wind are still there, but like you, my thesis is not really playing out there either. I honestly thought when the Labour government came into the UK that they would be more pro renewable energy, and it's just not being the case. And there's a lot of price and power pressures on the cost of energy, and that's affecting obviously their bottom line. So they are definitely on my list to review. But like that, I think they're the only one really that I have on my list. Yeah. The rest of them I'm kind of cleaning as I go.
So not a lot of spring cleaning coming up for you. For me, I think it will be a light season this year.
Good.
Yeah.
Nice. Shall we move on to listener questions?
Yeah, let's do it.
Okay. So the first one, a tough one from Dividend Controller. What is the one thing that I would advise you to stop doing, and then one thing that you would advise me to stop doing?
So for me, it would be buying high yield, low growth. I would advise you've got some high growth and high yield, but I would say a little bit more like the Microsofts in your portfolio and be opportunistic there.
Okay. I find this one a little bit more awkward considering you're probably 5 or 6 years ahead of me in the journey and almost at that FI number. So it's hard for me to say, stop doing this because what you're doing is clearly working and you're there. So yeah.
Yeah, but for you as well. But come on, say something that comes first to mind. Don't be shy.
No, honestly, no. I would say nothing comes to mind. I mean, I look at your portfolio. I mean, you have a nice balance. You do growth. You do dividend growth, high yield. So yeah, I don't really have that advice. If I'm honest.
Okay.
So, Jan has asked, any situation where you are fully invested, so you had no cash because you bought the dip and the dip dipped more and more and more?
Yeah, HPQ. HP Inc. It's now at €18 or $18 or $19. I'm thinking like, Jesus, I bought at 25 or something like that average price. Why is it the full position? I would love to buy more and buy more. And probably if it would have been in my early 2-3 years, I would have been just continuing to buy. But I've got a few falling knives and I don't want that. But HPQ is the first one that straight came to my mind.
Yeah, and I will be a shareholder in 7 days' time. Unless they jump above 20 euro. I have a couple of put options open on them. In my portfolio, I don't really have anyone that just kept dipping like that. I'm just looking at it there now. I kind of wished I did when Siemens dipped, when that was below 100, and I didn't have enough cash at the time. So that was one example.
True. In COVID, I was also very short on cash with all the opportunities there.
There were so many opportunities in the market. It was just hard to buy everything, to be fair.
Would you ever consider taking a loan if we would have like a 50% share price drop?
I think that takes balls of steel, I have to say. If I was a single man and no kids, no wife, probably would be more inclined to do it.
Yeah.
But taking that risk and then expecting my wife and kids to take that risk as well is probably a bit too much for Lee. But we had a guy on the show,
Cameron Stewart.
Cameron Stewart
did that with Meta.
Yeah, I mean, crazy stuff. I mean, if it works, you're a genius. But if it doesn't work, you're the opposite of a genius.
So you should actually not go to the bank, but loan from your family.
and never paying back. Oh, it's gone.
No, if you squander it around, you're just the uncle or the cousin that they just don't like because you squandered it. But what will they do?
Yeah. What can they do? Exactly. They can't bring it to court. But I mean, it's such a brave thing to do. Would you do it?
No. But I've been pondering about what I could do. And that's what I was thinking sometimes. Like, okay, maybe I should pay down my mortgage in a high yield interest environment. And then when there's such a time, just put some debt on the house that I know that I can pay from the cash flow that is coming in on a monthly basis. But still, to explain that to my wife and even to some extent to my kids, I think I wouldn't get an agreement. And I think these are financial decisions that you always need to do together.
Exactly. That's pretty much where I stand on taking that amount of risk.
Yeah.
I mean, to a certain extent, I have total anonymity. I can do what I want in terms of investing.
Yeah, but if you could buy for €100,000 loan, let's say on the mortgage, you take a bit more mortgage at a 6% yield in those times, and your mortgage is 4%, and you know you're scooping up Johnson & Johnson at a 5 or 6% yield. Yeah.
It's hard not to, or even let's go back 2 years ago, or even 18 months ago, you're buying Alphabet at $100.
Yeah, but I didn't have that conviction on this. For me in COVID, it was different. We knew that this is a special time. Yeah, and it only lasted 2 or 3 weeks, I remember.
Well, actually, Shell would have been a perfect one because it was trading around 7 or 8 euro at the time, and it doubled after COVID. So, yeah, but I just look, even if I was 99.999% sure, I could not take on that amount of risk without having my wife's agreement.
Yeah, I would need to have an agreement as well. But I of course I would talk the whole evening about her, about how this is the opportunity of a lifetime.
You'd have a presentation, and you'd have
exactly.
What are the risks? None.
Yeah,
no risk.
Exactly, no risk. No. Forget about the disclaimers from the central banks. Yeah, that it's high risk. Risk is only for people that haven't done their homework.
Exactly. There's no risk. Just do not get attached to the house.
Yeah. I will kill myself. You'll have to pay it.
Okay, fire investor. What investing behaviors have you got today that you think you would look back in 20 years' time and wish you knew better?
Well, exactly this what we discussed 30 seconds ago. No, but I mean, if I would know, I would have changed my behaviors now.
Yeah, exactly. I think that's such a difficult question to answer. What could I do better is probably the answer. Probably a better question. What could you do better? I mean, I don't know. I think over time you learn more. You try to apply that. But I mean, I hope in 20 years' time I'm a better investor than I am now because I've studied more, I've learned more, I've spoke to more people. But that comes with experience, not because of what behaviors I have.
So it's not about behavior, but the question that is a lot in my mind already for a few weeks, and that has really to do with what I wrote in my annual report. Like, is the American empire coming to an end slowly? And is my portfolio well enough positioned to protect itself from that? The dollar impact, the exposure to the American market. I don't have gold in my portfolio as an example. So what would it mean? And that doesn't mean that I expect it to happen, but if I just see how things are evolving, then this Ray Dalio has been right for the last 4 or 5 years, and I've been following him a lot. So it's written on the wall, and I'm just apathically looking at it, and it's just happening. And I'm not doing anything.
I'm reading a book that was recommended in Malmo, The Fourth Turning. I don't know if you were part of them conversations, but it's very interesting. It's how the world changes over 4 generations and how it repeated itself over history. And if it's true, and I mean, history rhymes, then maybe we are coming to the end of the American empire as we know it. There will be some changes in the next, 5 or 6 years. So it's quite an interesting topic, right? Because it seems like we're at such a pivotal time in history. There's a lot of stuff happening. We have Russia into Ukraine. We have Iran and America at the moment, and there's lots of different tensions happening in different periods.
Tariff wars.
It seems like the world is on a knife edge, and it's going to turn one way or another. Yeah, you're right. How is our portfolio protected is a very good
for
question.
instance, what about asset seizures? What if American just says like, hey, we're going to levy tax on all the American shares, and boom, there you go, additional tax.
And you might have think 5 years ago that was impossible, but we see that the taxes that he put on the world, or Trump put on the world in the last
of tariffs. Maybe he will soon say it's a privilege to own an American business, so you'll have to pay 10%. But also the Netherlands with their wealth tax, right? Like it really seems that the middle class is a group to harvest from at the moment. So I'm just wondering, is my wealth protected enough from that or not? And that's where I have my doubts, let's say.
Yeah, because I would say we're diversified within the stock market world.
Exactly, but what about the stock market in itself?
Exactly, and then even outside of the stock market, it's a very good question, and there's a topic for us. Good topic. Hugo, on fire. How do you deal with market volatility and keeping your anxiety levels controlled?
I'm too busy with work that I don't even have time to check the market. So just work harder, Hugo. Just work harder.
Get so busy that you can't even have time to look at
it. Exactly. So I haven't seen a lot of volatility in my portfolio, Hugo, to be honest.
Yeah, me too. My portfolio is still up. It's kind of floating up and down between the same price range over the last week, I would say. But yeah, I mean, market volatility, I think as a dividend growth investor, it matters less than me.
Yeah,
I think that volatility for me is in terms of income, and at the moment, my income is like clockwork. I'm like Johnson & Johnson. I'm getting income every week, and I don't really. The share price doesn't really affect me as much. I have to be honest. So, you know what probably helps? I have a couple of different portfolios. I have 3 brokers, and so I don't know my total value the whole time. I'm not looking at it. I just look at whatever dividends I receive. So that probably helps. I don't really care about share price. I do care. That's a lie. I do care over the long term, but
not in the short term.
It doesn't affect me emotionally. So I don't have anxiety, and it doesn't bother me.
No.
Overachiever. What do you think about turnaround strategies? Have you been listening to this show for 280 episodes? we had, I don't know, we had an 18-month period where we spoke about nothing but turnarounds. We had Intel, we had Walgreens, Who else did we have? We had BASF. We had lots of different VFC.
Yeah.
So many turnarounds. And I think the lesson, I'm not going to speak for you, but the lesson I learned, and we learned the hard way, is I don't really want turnarounds when it's before that has turned around. Let's put it that
way. Exactly.
Um,
but a turnaround is not a company having a bad quarter or one or two.
Maybe even a bad year or two.
For instance, was Texas Instruments for you a turnaround with their CapEx investment cycle?
And we had this discussion, and
I know.
Yeah, and I was leaning on, like, they have free cash flow. What are we going to do? So I would have kind of at the time put it in a turnaround, but not in the sense that Intel was. They weren't losing market share. It's just that their cash flow was coming under so much pressure. It's how that they deal with that while paying their dividend and share buybacks. And
I just saw it as an expansion that they need to invest for in the future. And they can do it with debt, or they can do it with cash flow, or a combination of both, right? With Intel, it was clear. Well, not clear from the beginning. It was clear like 1 year or 2 years in that they suddenly started to really heavily lose market share.
Yeah. And I think that's probably the key difference in a turnaround and someone that's just going through a bit of a cycle with free cash flow. So
now, if I can avoid a turnaround, I do it. But sometimes companies in your portfolio become a turnaround, and then we go back to the Deadwood question that we had earlier.
Exactly. Yeah. Poses a different question, but in general, overachiever. It may have worked for Siemens Energy, for example, like you mentioned. Steph, you're still waiting to come back strong. I remember in the early days of this podcast, we were getting someone onto us all the time about buying BASF. BASF, they're going to turn around. It's a great company, which they are. They just made a really shitty acquisition. But it's been 6 years and we're doing this podcast and it still hasn't turned around. So
exactly,
that tells you a lot. So look, in general, my consensus, no. I
exactly same here.
I don't want to be in turnaround strategies. Cajolas, that's quite a funny name. Care to share prompts that you use on Claude or other AI sites? I give them my portfolio and ask them once per week news or highlights that has happened with the stock.
Yeah, no, I don't really have anything specific. But remember last week about GRWIG? He put on Twitter, a lots of prompts that he's using. Remember we asked him like, hey, how are you? Check the tweet that we had about the question for the week. And in there, he posted all his things. Maybe I can put the link in the show notes, Derek. I will give it to you. I think he gave really, really nice that I would like to try out a little bit. But Kayolas, I just read myself. For me, I don't want to outsource my own thinking. We spoke on quite long about it last week, and I'm in this position that when I read the earnings report, that I can quite quickly do the math for the things, and I prefer that because also I train my mind better. It will stay longer in my mind. If I notice if I use prompt, I don't internalize the knowledge. Yeah, and I feel like it's needed for me. I'm this person that wants to know what I own. I want to know the data. So often when you reach out to me, I can tell you for many of the stocks, I can kind of tell you what the situation is, even in data. So that's just my way of working. So I understand I can save time with it. So I use it sometimes like Notebook LM, where I upload all the 10 reports and I wanted to make a table for me. But I'm not using it if you talk about prompts like for screening or something like that, or give me all the let's say I have 10 metrics that I typically analyze a company with. Give me the metrics based on this company. No, I'm not doing that. I don't feel I need that. For me, also the dashboards that we have based on the APIs is already good enough. So I feel like I'm killing trees for something that already works for me. You could argue, should I do a whole deep dive via prompts? No, again, because if you look at our deep dives, for instance, that we publish, there's a lot of facts in there that I think AI would never grasp. Yeah, even the laugh for Walter Kluwer's early days or something like that, or Relax, that's a combination of Elsevier. Having known the Elsevier brand when I was a young kid, and even the books they published, it's something that I've never seen coming out of AI, because that's my memory and how I look at businesses. Yeah, so it's also very personal.
Yeah, yeah, and remember, investing is an emotional journey more so than anything else, and you have to have some emotional attachment to something. Like if you're investing in something company, you have to have a feel for what they do. AI is just going to give you numbers, I think, and it's going to give you
Yeah.
sentiment that maybe it pulls from, I don't know, social media. I don't know wherever it pulls it from, but it's not going to be authentic, in my opinion.
Yeah, and then don't get me wrong, I think AI is going to give us a lot of productivity gains. If you can build your own Bloomberg terminal using AI for your stocks, amazing. Yeah, and this is where really game changers will be. But when it comes to the most of the prompts that I use is still like fix my English and these kinds of things when I'm writing about stocks. Notebook LM I find really powerful because it really looks only into those sources. I use Perplexity with the quarter integration, and it sums up some things. But no, I'm not. I don't need to for me to calculate the debt to equity ratio. I just open the balance sheet and I look at the long term debt. I look at the equity and I see the comparisons over a few years and I see what the trend is. That's how I'm wired, and it doesn't cost me a lot. I think I would spend more time on the prompts, even if I automate it. I would probably get answers out of it. And I think like, and then I would go back into it again to in the end still look up the balance sheet. So call me old school, and that's probably the right word. I use AI a lot also in my work. I'm a big fan of AI, but for this one, I think I'm already optimized a lot that
Yeah,
I don't need a lot of AI for this.
yeah. I think in Perplexity, I have my portfolio inserted, and when I go to the finance section, the news will be relevant to my portfolio. So that's one thing I have. I don't ask it questions. It's just when I go to it, it will show news relevant to that. But other than that, I don't go to Claude or anything else asking that many questions, I have to say. But I do like Perplexity, but because it's just so easy to get the earnings transcripts, and it's like Quarter that you use, obviously, to have Quarter integrated into it. So yeah, that's pretty much my level of AI. And honestly, I just feel like I get too reliant and too lazy. I noticed myself in work, because we've Copilot integrated, and that integrates really well. I use Visual Studio a lot, and it integrates into that. And I found myself, when writing code, starting to rely on that. And then when I'm thinking about what I did, I'm like, I don't have the understanding because it's AI. So
Yeah.
I've now blocked it. I write my code first, and then if there's a mistake, I'll ask a question, find a mistake.
I do the
Simple.
same all the time with AI. I'm always first writing down my thoughts, and then I can ask AI to challenge it, what is missing, or make the story a little bit better out of it because I'm missing still this and this. But really, the first thinking must come from me. We're individuals. We are unique in our thinking. People also will see it when it's AI, and I think there's a lot of lack of substance then.
Yeah. Yeah.
Not saying that with AI, maybe you could build an algorithm and outperform the markets. Maybe you can do better than us all together, right? But no, this is how I look at it. Yeah.
Yep. Martin V has asked us, which companies have the biggest moat? And he's thinking about analog, digitalized data that's not yet indexed or recognized. And he gave an example like FamilySearch.org, which has a huge archive of scanned birth and death certificates. Any companies come to mind?
This is what I did a bit of research on also in terms of Relax and Wolters Kluwer. They've got like 100 years of data in some of their databases from stuff that they had to digitize themselves, courtroom filings, all this kinds of stuff. So I think they have a lot of proprietary data that is still required in the legal space because you're often looking for precedents, for instance, for a court case happening in the 70s. So yeah, I think those kinds of data providers, not the aggregators here, I think they will have a hard time, the news aggregators. So, but stuff like that, yeah.
Yeah. People with their own proprietary data, it'll cost a lot of money.
Yeah, and data that you can't easily recreate. Yeah. I think that's very important.
Yeah. Exile has asked us, do we have any interesting non-US monthly dividend payers? You obviously mentioned Cebus quite a bit, but is there anyone else that comes to mind?
No, not for me. I know there's some stuff in Canada, but I'm not familiar so much with the Canadian stock market. So the answer is no. I think you spoke the other day about this JP Morgan ETF.
Yeah.
Yeah.
Legal and General ETF, was it?
Legal and General ETF, yeah.
Yeah.
But I believe you were not a big fan of it, right?
ETFs are not my space, really, as we said, and it's still early days. So, I didn't really have too much of an opinion. We did get a comment on that to say that we did not speak about what index it follows and so on. But my answer to that was, I'm not an ETF person. So apologies from my end. But yeah, there's probably a few ETFs out there that are paying monthly dividends that might be interesting. But in terms of European monthly payers, I can't think of many.
No, me neither.
Can't think of many. Stefan and MB657 have both asked us about Legal and General, what the results are like. They seem to lag dividend growth versus their peers. And what are your thoughts on them?
So they are a bit different, right? If you look at, for instance, the ASR and NN Group, they are huge, really huge in, for instance, life insurance. Yeah. And if you look at Legal in General, it's a lot about asset management, institutional retirement. I think ASR is really building this up a little bit now, but also retail. And so it's a different kind of company, I would argue. So that's one. And then the question about the results, I think, it made almost 21 pence in earnings, 10% or 9% up compared to the year before. It has a 210% solvency ratio, much more than they need. Yeah, typically it's above 150, and then they have their targets at 170. Stock price dropped, by the way, by 6%. And I think it was just because the earnings, the operating profit was a little bit below what the market expected. Also, the asset management unit didn't grow too much. But what for me was a little bit more interesting is that the Solvency II ratio dropped to 210% from 230 in 2024. But we know that also their US insurance assets are being disposed. So that has to do with that. This deal that they did, I think, was this Japanese company. And they are also lowering the solvency ratio requirement to, they just want to reward shareholders more. So they want to pay out more of their cash, I guess, in terms of buybacks and such. All in all, it was, I guess the market just expected more. The dividend is near payout ratio. On the operational cash flow, it looks a bit better here. But in my opinion, it's kind of doing what it's doing, slightly underperforming, maybe, but nothing to be concerned about. We know that this is a high yield business and that their dividend growth over the next few years should be fine. Their portfolio is a bit in transition, so it needs a bit of time there as well. And so far, management seems to be doing what it said it will be doing. Is this the quality of ASR and NN Group? No, not in my case.
That's why you're getting a 9% yield for that additional risk.
And no dividend tax at source, but still you need to pay your own dividend tax then for most people, at least in their home country.
Yeah, exactly. And remember, not all insurance companies are the same. We speak about ASR, we speak about Munich RE, we speak about NN Group, but not all insurance companies are the same. So we can't paint them all with the same brush. Two more questions, and one is from EV, and he's asked about Louis Vuitton, Moet Hennessy. Are they a good buy after the recent drop, or is there a bigger worry with these brands like Hermes that have dropped as well over the last year?
So actually, I'm looking, and I'm a little bit in the minus on them. I've got an average price of €490 per share. Interestingly, I didn't know it. So if you wouldn't have asked, Evie, I wouldn't have known it. No, I'm not concerned. Of course, the spirits business is not having the best time of their life, let's say. That's an understatement, I guess. But no, I mean, the days of heavy growth, let's say, that it experienced in the mid-teens to 2 years ago seems to be a bit over. It was a lot because of China as well. We know what China is doing at the moment. Maybe also there's some anti-Western sentiment. So, but this is a company that went through those waves for many times since Bernard Arnault started this company. So personally, I'm not too concerned. There's really high quality stuff behind that. Really high quality stuff. Still, if you look to their brands, you see that people really have this feeling like if they own such a product that they feel like, I own something. Like Rimowa suitcases. I was in the airport the other day. It's still a very popular brand. Yeah.
Yeah. This is one of these companies that, okay, you say is a high quality company. You look at the share price over 5 years, it's gone nowhere. Pretty much flat or down a little bit. They have a 2.5, 2.6% dividend yield and no growth over the last couple of years. So, I mean, you think of your thesis. Has your thesis changed? Is this Deadwood? This would be one of those companies that would fit into that bracket for me if I owned it.
Yeah, for me not. I started to buy it last year actually, because I see it is doing this and study this history, and I know it's kind of every time jumping on a new S curve.
Yeah. No, and I get your point on that. But how long do you wait? And for me, it would just fit that category because of the lack of growth in terms of dividends and share price.
Yeah.
And then the last question goes to Yedida. Are you guys buying Oracle after its recent earnings? Seems like everything is going well for them except the share price.
I'm not a big fan of Oracle, to be honest. I worked too much with Oracle databases in the past and Exadata, where they were screwing us off with the Exadata pricing. I mean, crazy pricing. It's still in my head.
I currently work with Oracle databases as well. But look, I am not buying them. If I'm honest with you, I know they've had a lot of good news recently, and there's an AI aspect to their databases now that you can leverage. But I haven't actually looked into them enough to give an honest answer on that. It was never on my radar before. I'm not one just because there's a single hype about AI to just go, I'm buying it now. So yeah, I haven't looked at it. So the answer is no. I'm not buying it.
Yeah.
Let's see. But they had strong revenue growth, if I remember, year over year, 22%, which is
kudos to them.
Yeah, decent. Yeah. So that is the end of the show. Again, as always, thank you to all our listeners for all the questions, and we hope you enjoyed this episode. If you're running, keep running. You're nearly there, and we will see you all next week.